Welcome to the ultimate Bull Run Playbook. If you're gearing up for the next crypto cycle, this video is packed with game-changing techniques to help you maximize gains whilst navigating the market's unique challenges. If you're new here, my name is O&F, and with 8 years in the crypto markets and now on to my third cycle, I'm here to share everything you need to know to thrive in the upcoming bull run. By the end of this video, you'll understand how to assess your edge and use it to your advantage, the best strategies for active and inactive investors, and my proven system for timing your exits as best as you possibly can. Whether you're a seasoned investor or just starting out, stick with me as I break down this comprehensive guide step by step. Let's make this bull run your most profitable cycle yet. We start off very importantly with number one, assess your edge. Are you a trader, an investor, or both? Honesty is critical here. Be real with yourself. You should only be trading if you have a track record to support that decision. Realize that most would benefit counterintuitively to a hands-off approach. And unless you're a very experienced trader, let the current carry you. At the least, if you do choose to trade and you don't have years of track record to support the idea, then you should wait and only take longs when everything is clearly in easy mode. Now on to number two. Decide how active or inactive you want to be and set this decision in stone before you embark on your journey. Is this your full-time hustle or do you work a job? What we're doing here is just trying to set and work out some parameters for you. And only you can answer these honestly, but you have to be honest in your answers because ultimately this will shape how best you profit from the upcoming run. Now let's dig into this a little further. If you chose inactive, then the approach that would best suit you is to buy and hold the projects you believe will outperform and keep a vague eye on the market with the idea to start paying more attention in a few months' time as per your exit. This isn't to say you exit in a few months, it's to say you start paying more attention in a few months. Many think increased effort input equals increased financial output, but the reality for most is less is more. What I don't want you to think is something that I thought for many years, is that if you're not doing anything, you're not going to get the gains. I can tell you guys from personal experience that during aggressive crypto bull runs, many investors and position traders outperform a bunch of people that are hyperactive in the market. Now, if you'd said that you were taking more of an active approach and this is your full-time hustle, I have one thing to ask of you guys. Write out your strategy. I want you to try and get this down to one clear and succinct sentence, and this will really help map out everything for you. Essentially, what we're doing here is just writing down our mission statement. And it's incredibly important to get it in writing, as this will be your mantra for the bull run. And by having it in writing, you can see whenever you're deviating from your plan and simply return to it, get back on track and follow your objective. Now, to lead by example, I've written mine down here, and it's to hold a portfolio of my chosen fundamentally strong mid and low caps, trade the highs and mids, and filter these trading profits into new launches as I go, using my PCVS system to time my exit. Now, don't worry, I don't expect any of you to know what a PCVS system is. I'll be covering it off towards the latter end of this video. Number three, and this one is really only for the active participants, determine your rules and desired portfolio split. I'd suggest that unless you're an extremely experienced trader or player on-chain, your best approach is adopting the following portfolio split, being 70% alts, 15% stablecoins, and 15% of your on-chain currency, such as Ethereum. So we have our 70% and majority of our portfolio in altcoins. This is comprised of long-term bets on projects varying from lows to mids. Always focusing on the new hype narratives and only investing in lows or micros if they are truly irresistible and doing so lightly. It's good practice to earmark a 10% max allocation of your total portfolio portfolio to these smaller caps. Don't get wrapped up in how many X's this could pull without factoring in that these are higher risk plays that you could lose all your invested capital in overnight. And also realize that generally speaking, these will take the longest to play out due to the trickle down effect. BTC first, then high caps, then mids, then lows. Of course, with exceptions. You can start scaling into lower caps more so as the cycle progresses, as their time to shine will be towards the end. You must, in advance, define those that are must not touch alts in your portfolio, and you will naturally break this rule if they start hitting crazy multipliers, but at least it means you hold off until the gains are truly irresistible. Then the remaining part of your portfolio is 30% across on-chain currency and stables, and this is just in case we get any severe dips across the board. This is the best balance I found between having max exposure in the time you should and having some dry powder to be able to feel like you're taking advantage of dips, but most importantly, viewing these as opportunities, not problems. Now, please take it from me. It may feel like the best approach is going all in and having max exposure, but you've already deemed yourself an active participant in the markets. And as a result, the best way you'll perform is being nimble, liquid, and ready to attack any situation that presents itself. 30 to 40% corrections can occur in bull runs, and you need to have at least a little bit of dry powder to capitalize on these moments. Just remember, you're taking part in an incredibly rare wealth creation opportunity, and you should be enjoying it. And by adopting this split, you'll make sure to maintain a positive outlook throughout the whole experience. When things are going up, all is well because you've got the majority of your portfolio exposed to the market. But vice versa, when we do have those flash crashes and corrections, you're well prepared and able to capitalize on those opportunities as well. On to number 4, and this one is again for the active participants only. Recycle partial profits as your holdings start going parabolic into new launches as they occur throughout the year. Again, define whether these are flips or must not touch coins dependent on their fundamental analysis. Remember, the biggest gainers of each and every cycle are new coins. The market is still hugely driven by hype and speculation, and the hot new runners are where you want to be both initially positioned and dipping into. This will ensure you maximize value as the cycle progresses. Now, number 5, and this one is both for the active and inactive participants as we're trying to time our exits. 99% of new investors and traders in the crypto space don't think about their exit in advance, and that's something that I really want you to change today. I've personally found immense value in planning exit strategies in advance, and although you may not want to focus on that right now, I promise you'll not regret doing so. I've seen many people hold their coins all the way up and all the way back down again, and I guarantee that putting these systems in place will truly help you come out with much more in your hands and your pockets. And to best do so, I've put together a diverse system called the PCVS, which stands for personally based, chart based, valuation based, and socially based. Now, what do these mean? Well, personal is simply selling into euphoria and when the amount you've made seems outrageous to you personally. Next, we have chart-based signals such as higher time frame divergences on Bitcoin, deviations, or parabolic increases. So again, to lead by example, I'm going to show you how I exited the last cycle based off the chart-based signals on the higher time frame. Here, we're looking at Bitcoin on the daily. So you can see that we had this first rally up, we came back down and went for another higher time frame leg up as we did. We took out this swing high here, and then we took out this local high yet again here. So we have a higher time frame sweep of a historic level, then we have a local sweep up here, and look what happens as we do so. We can see clearly on the awesome oscillator the momentum drop off as we make this increase. We have the candle bodies making a higher high and both oscillators clearly making lower highs. Now, I'm not going to pretend like I exited at the Pico top up here, but I started to scale out of most of my positions in this area here as we started to get deviations and confirmations of closes underneath this level on the daily. Then I exited the remainder of my portfolio as we started coming down and closing here, as we clearly lost this low, which is a loss of higher time frame market structure and a clear sign of Bitcoin and subsequently the rest of the crypto market's intention. Next, we have valuation based, which is predetermining what valuations you'd expect your individual projects to hit in full bull. I'd suggest erring on the side of caution when doing so and not overshooting the mark. Much better to be conservative and humble here. Lastly, social. And this may seem incredibly random and arbitrary, but I've seen it play out many times before. Some of the smartest investors I know take social metrics into their decision-making process. And essentially what I mean is simply observing when the people around you or on social media start arrogantly flashing stupid amounts of cash that they've made, whether this is in the form of cars, watches, P&Ls, or whatever it is. History repeats itself time and time again. And at the top of these cycles, you'll always see flocks of retail trying to pile in at the top, arrogant flashing of cash, and general predictions for much, much higher. Now that we've gone through the format of the exit strategy, you need to determine your weighting. For instance, with evenly distributed weighting allocated to each, you'd exit 25% of your portfolio when you felt the amount you've made seems outrageous to you, 25% of your portfolio when you saw the necessary higher time frame signals to do so, 25% of your portfolio when you started hitting the expected exit valuations you had predetermined for your projects, and 25% of your portfolio when you start to see obnoxious and arrogant boasting of profits or other socially based top signals. Now, the split that you need to allocate is completely personal and up to you. If, for instance, you're an experienced trader or chartist, you could weight things more so towards the charting exit. If you're wisely humble in your ambitions, you could weight things much more to the personal targets. And likewise, if you have a deep understanding of valuations and fundamental analysis, then maybe you could skew things a little bit more towards the valuation side. Personally, I'm planning on exiting the majority based on the higher time frame chart-based signals, but still using the other three variables as exit triggers. But again, this is me playing to my strengths. For most, I'd recommend a strategy skewing weighting towards personal gains. Now, we've got you set up for the bull run in terms of investing, but to truly capitalize on the gains ahead, you need to learn how to trade these conditions too. And for that, I've got the perfect video for you. So go ahead and click here. This will be all you need to nail the markets on both sides.